Have you noticed something a little strange happening at the very top of the business world? A massive, almost coordinated sell-off by some of the most famous founders and CEOs on the planet. And we're not talking about a few shares here and there. We are talking billions of dollars being taken right off the table.
Okay, so let's get right into it. Now look, insiders sell stock all the time, right? Maybe they're diversifying their portfolio, funding a charity, whatever. But when you see this many of them selling this much, all at the same time, just as the market is hitting brand new highs, you kind of have to ask, what's going on here? In this explainer, we're going to unpack the data behind this whole trend.
First up, the big one, Jeff Bezos, founder of Amazon. Just in 2024, he has cashed out over $13 billion worth of Amazon stock. Now, the official story is he's moving to Florida for tax reasons. Okay, fair enough. But he's had 25 years to make that move, so why right now? See, it's the timing that really makes you go,
And he is not alone. You've got Mark Zuckerberg over at Meta. He's also been unloading billions of dollars worth of his company's shares, right as that stock is soaring to record highs. And again, while the stated purpose is to fund his philanthropy, just like with Bezos, the timing lines up perfectly with a market peak.
Okay, but this next one, this is the one that really gets your attention. Jamie Dimon. He's the CEO of JP Morgan Chase, one of the most powerful figures in all of finance. And for the very first time in his 19-year career leading the bank, he sold his own company's stock. I mean, come on, this is a guy with an unparalleled view into the real economy. That's not just a signal, that's a massive red flare.
And when you start adding in the sales from the Walton family of Walmart, Larry Ellison from Oracle, and a whole flood of insiders at NVIDIA, this stops looking like a coincidence, doesn't it? The analysis we're examining today calls this the largest coordinated insider selling event since, wait for it, 2007. And we all remember what happened right after that.
So let's start by looking at the sheer scale of this sell-off, just to really understand how significant this is.
Just look at that number. $464 billion. That's how much stock corporate insiders have already sold in 2024. According to the data, that puts this year on track to be the second highest year for insider selling on record. And the only year that was higher, you guessed it, 2007. This chart right here really puts the whole thing into perspective. In a typical market, you expect insiders to sell about $3 of stock for every $1 they buy. That's considered normal diversification. But in 2024, that ratio has just exploded to 9-to-1, and in some months, it even hit 12-to-1. This is not just diversification anymore. This looks a whole lot more like a directional bet.
And this brings us to a really powerful historical parallel. The pattern we're seeing today looks remarkably similar to what happened right before the last major financial crisis. Let's just take a look at the timeline from the last major cycle. In early 2007, insider selling hit a record $650 billion. The market then peaked in October of that year. And just 12 to 18 months after that wave of selling began, boom, the global financial crisis was in full swing. The insiders, though, they had already gotten out, right at the top.
The parallels are just striking. In 2007, it was the CEOs of the very mortgage lenders and investment banks at the heart of the crisis, places like Countrywide and Lehman Brothers, who were selling like crazy. Today, it's the leaders of the biggest tech and financial institutions in the entire world.
So, what could possibly be driving this exodus? Well, the analysis points to a whole series of flashing red economic indicators that suggest the market might be in a very precarious position. First up is the Buffett Indicator, a metric Warren Buffett himself called the single best measure of market valuation. It basically compares the total value of the stock market to the size of the whole economy. Right now, it's at 185%, meaning stocks are valued at nearly double what the entire economy produces. According to this metric, that's deep in bubble territory.
Next up is the Schiller PE ratio. This one smooths out earnings over a decade to give a more stable picture of valuation. Its current level of 34 is the third highest in all of history. The only two times it was higher were right before the dot-com bust in 2000 and during the COVID spike, and both of those were followed by major market crashes.
This is a big one, margin debt. This is money that people have borrowed to buy stocks, and it's currently near a record high of $950 billion. Now, this kind of leverage is dangerous because when the market turns down, it can trigger forced selling, which can cause a small downturn to cascade into a full-blown crash.
And the warning signs just keep coming. We have 12 times trillion in corporate debt that needs to be refinanced at much higher rates, a commercial real estate market in crisis, and a historically reliable recession indicator that's been flashing red. But maybe most importantly, these insiders see their own internal data, giving them a preview of a slowdown long before it ever becomes public.
So, given this backdrop of heavy insider selling and all these economic red flags, what does the analysis we're looking at predict is going to happen next?
The analysis lays out a pretty clear three-stage pattern. Stage 1 is what we're seeing right now, massive insider selling right at the market peaks. Stage 2, based on that 2007 timeline, is a predicted crash sometime in late 2025 or early 2026. And that leads to Stage 3, a period of maximum fear, which becomes the prime buying opportunity for anyone who preserved their capital.
Now, this explainer is not financial advice, but the analysis does conclude with a potential playbook based on this pattern recognition. So let's look at the key takeaways.
According to the analysis, the strategic playbook is pretty clear. Consider reducing your stock exposure to preserve capital. Get a buy list of high-quality companies ready to go so you can acquire them at a discount if a crash happens. The analysis also points to gold for wealth preservation and strongly advises against trying to short the market, which is incredibly difficult to time. The core idea here is simply to get out of the way.
The core message of the analysis is summed up perfectly right here. It argues that the people with the best information aren't whispering, they're shouting. Their actions, selling billions of dollars in stock at market highs, are the clear signal they can possibly send.
And so this is the thought we're left with. The pattern seems clear, the historical precedent is there, and the actions of these top insiders are undeniable. According to this analysis, they are sending a message with their money. The only question is, who's listening?